Amid rising tensions over technology and geopolitics, American billionaire investor Ray Dalio has warned that the conflict between the U.S. and China could develop into a capital war, which would damage the dollar. Meanwhile, international investment bank Goldman Sachs warned recently that the U.S. dollar is in danger of losing its status as the world's reserve currency. So how likely is a capital war between China and the U.S.? Will the dollar lose its reserve currency status? And as economic ties suffer, what are the implications for the U.S. and the world economy? To talk about these issues, I'm joined in the studio by Anar Tongan, independent current affairs commentator, and via satellite by Hong Hao, chief strategist at the Bank of Communications International, and Rebecca Christie, visiting fellow of Bruegel. That's our topic. This is Dialogue. I'm Zhou Yue. In a recent interview, U.S. billionaire investor Ray Dalio and founder of Bridgewater was quoted as saying that when it comes to China-U.S. tensions, there is a trade war, there is a technology war, and there is a geopolitical war. And there could be a capital war. So, Anar, do you think we're now also seeing a war in finance and capital?
Yes, and actually it started quite some time ago. Remember the SWIFT system, which is the banking system by which you're able to transfer money around the world. That actually became weaponized by the U.S. When it was first started in the 70s, the whole idea was that this would be neutral. This would be the Switzerland. No one would ever,
no one would ever touch that.
Touch it, use it as an offensive weapon to get political gain. So this is something that Donald Trump has, really gone overboard on. I mean, anybody who is involved in anything he doesn't like, he starts putting on not only tariffs, but these kind of sanctions, and he enforces them through the banks and, in essence, through the SWIFT system. So you've seen Europe, China, Russia, Iran, Venezuela, and the rest of the world is also very nervous because they don't want to be literally under the thumb of the U.S. when it comes to finance.
And Hong Hao, what is your take? Because Hong Hao is not available at the moment. Rebecca, do you think the U.S. will go to that far? Because even Secretary of State Mike Pompeo admitted that China is totally integrated with the world economy. Can America use finance weapons against China?
Looking specifically at the U.S.-China relationship, there are still very strong economic ties between the two economies. Politically in the U.S., it's an election year. China is one of Donald Trump's favorite targets for talking about foreign threats and various mysterious actions that he would like to counter. But when one looks at the practicalities of it, the dollar is the reserve currency. Investors who don't like the dollar are going into gold, and there doesn't seem to be a whole lot of room for really severing the ties. I do not expect capital controls. I do not expect the dollar to stop being the main reserve currency for transactions. And although things are tense, we are not yet at full war.
But we have seen some worrying signs recently, Rebecca, because capital flow between China and the U.S. has been on the rise until recently. But Dalio mentioned if the U.S. government bans investment in China, withholds bond payments on Chinese debt, the result could be a deep decline for U.S. economy. Should we worry about decoupling in finance?
Those are a lot of big ifs. That's a lot of catastrophic scenario hypothesizing. If the U.S. were to not make any bond payments to anyone who has invested in its debt, it would devastate the U.S. economy globally, not just in relations with China. That is not something that I think is likely.
And Anar, what do you think? Well, that's a big decision to make, of course, for the United States. But this is an unusual circumstance.
Yeah, well, let's separate the issues here. First, you have, from a strategic level, I agree with my colleague. These are very drastic actions. But if you start looking at what Donald Trump is willing to do in order to further his political career, then you start to get a little queasy. He's already started a campaign to, in essence, say we don't want any Chinese companies listed on our bourses. We don't want them here raising money. We don't want students. We don't want teachers from China. In essence, declaring everybody from China a spy. So this kind of nationalist talk can, in fact, lead to this kind of financial things. Now, Donald Trump isn't worried about the long term. He's only interested in the short term, and that's what concerns me.
But what is driving Donald Trump's decisions and his China hands? Hong Hao, a lot of people say ideological divisions are behind this, but do you think the decision makers are only driven by ideological differences when they are making important economic decisions?
Well, it is puzzling indeed, because after all, there's a presidential election in November, and there's not a certain guarantee that Donald Trump will be re-elected. So even though if you want to implement some sort of ideologic implementation now, with in a confrontation with China, I would say that Donald Trump is running out of time, especially the chance of him getting re-elected, given the poll result, is declining. So I would say that it is puzzling, but then at the same time, I think it's a bit too early to be talking about the U.S. dollar losing its reserve currency status. That is because after almost 10 years of China trying to make inroad into making the CNY, the Chinese yuan, into a reserve currency, I think it's now less than 2% of the global currency reserve. So as a result, I think it is still a long way to go for the Chinese yuan to challenge the U.S. dollar, or for the U.S. dollar to lose its prime reserve currency status.
But that now is more difficult than ever because the political atmosphere in America extols it for Chinese investors. Last week, Senator Marco Rubio urged Trump to pursue even tougher measures on Chinese companies listed in the U.S. He said, planning a bill to ban Chinese companies from U.S. capital markets because they engage in espionage, human rights abuses, and support China's military. So that means the Chinese investors and Chinese currency, for example, capital, go outside. It will be even more challenging.
Yes, to a certain extent, and that is the reason why we're seeing increasing U.S.-listed Chinese firms coming back to Hong Kong. I would say that it's actually creating opportunities for investors here, and also for Hong Kong as an international financial center. The market is well participated by global investors, so U.S. investors are also investing in the Hong Kong market as well. And also because the Chinese listed companies now having a growing investor base based in Asia. So considering the time difference, for example, if you want to do an earnings call after the results, you don't have to do it in the middle of the night anymore. You can do it in Asian hours. So it's actually investor friendly for the market here. So I would say that to me, once again, it is puzzling why the U.S. market wants to drive out the Chinese listed firms. After all, after so many years, many of the Chinese firms has given the U.S. investors tremendous investment gains.
But are you saying that it is not a big deal that the Chinese businesses are withdrawing from the U.S. capital market because they can have Hong Kong as an alternative?
It is not a big deal for investors who are interested in participating in the Chinese growth story. I think it's a big deal for the U.S. capital market, because if you look into the future in the next 7 to 10 years, the expected return you're going to get from the U.S. market, given the current very high valuation, is probably about 3 to 5%, maybe much less than that if you're lucky. And yet, I think China and the rest of the Asia is growing very strongly. So I would say that especially for pension fund investors, they need long-term stable growth, to fund the retirement liabilities. So I would say that, if you miss out a growing market such as China, it is a really bad news for U.S. pension fund investors.
But considering what has been happening in Hong Kong and the U.S. determination to get rid of those favorable policies and even treating Hong Kong as the Chinese mainland, is it possible that those IPOs happening on the Hong Kong market will be anything different from their listing in the mainland markets?
It is still different in the sense that for now, China still largely have capital control. It's easy for capital to go in, but I think it's a lesser story for capital to want to move out as quickly as possible. So I think, for example, in a sell-off, dramatic sell-off such as in March, what happened is that if you're a global fund, you're facing redemption pressure, and you want to sell down some of your holdings in, let's say, a domestic Asia, Chinese market, and then you want to repatriate your funds to meet the redemption needs. The problem is that, because of the capital control, there is a chance, there's a contingency that you may not be able to repatriate your capital. So I think that's sort of a contingency or risk that global funds have to face when they invest in mainland China. I think that's the reason why many of the funds investing in China now, they're very, very long-term focused. Some of the funds has been there for more than 10 years and reap tremendous gains from the Chinese domestic market. But I think for Hong Kong market, because it's globally participated, it doesn't have any capital control requirements. So I think, to suit the global fund needs, Hong Kong market is a better choice.
And Rebecca, earlier it seems you wanted to chime in on whether there is the possibility of decoupling in the capital markets, because obviously the U.S. want to delist some of the Chinese companies from their markets.
Yes, thanks for coming back. If you look at the fixed income market, foreign exchange, the bond market, if you look away from equities, you'll see a lot of ties going around the world. These are the sort of things that are long-term, that are infrastructure focused. It's politically expedient for the Trump administration to talk about hampering these sorts of ties, but it's also easy to leave them in place doing their very important infrastructure job while the rhetoric may or may not score the points that he's looking for from voters.
But what about the message sent to the investors? When they're putting investments in somewhere, they have to consider whether it's secure, whether it's stable, whether it's sustainable. Einar, what is the message for investors?
Well, the message depends on who you're listening to. If you're listening to Trump, he's trying to create uncertainty, and that's why you've seen a lot of actual investment, not where you're putting your money, but companies investing in new products and new factories going down. No one is willing to do anything until they can figure out what's going to happen. But you are seeing a tremendous amount of hot money flows flowing into China for the exact reasons that my colleague said. But I think there's a danger of using traditional finance ideas. I was an investment banker. You look at these things and you say, oh, well, we know what's going to happen, 3 to 5%, doing these kind of projections. But the fact is, we've entered into a new paradigm. The old ways do not work anymore because we have new sets of problems. And what I am paying a lot of attention to is the fact that China has developed an e-currency. And this will get them around these kind of capital controls because they will be able to trace where money is coming in and where it's going out. And this could be a real game changer. Remember, China is the primary trade partner for over 120 countries. So in that kind of scenario, why are you hedging money in the U.S., which, as my colleague said, could be going down, not as stable as it was. We've already seen the dollar at a 22-month low. But so there's no questions about that.
That will lead the question whether China will open up the capital markets. That is a big thing, big decision to make if you want to let loose capital control.
Yeah, but that's my problem with it, is don't define it as opening it up completely the way it is done in Europe and America. What China will probably do is have a hybrid method. Everything that China's done is on its own path. So this new e-currency could be, as I said, a game changer, a way in which it is able to ascertain that money flows are not going out for illicit purposes or for avoiding taxes and things like this.
Hong Hao, what is your take on whether this is a good time, and in what way China should probably let up control of capital, and so that we don't rely on American assets that much?
Yeah, I would say that if you look at the path of financial reform and open for the Chinese market, I think ever since the trade war is actually accelerating. So I think now we're letting more and more foreign capital to participate in the Chinese market. So I would say that even though originally we had rather restrictive capital control, but now we're relaxing it. And I think in 3 to 5 years, you would be looking at a completely different Chinese domestic market. And also in terms of the bond market, I think the Chinese bond market has more than tripled in the last couple of years. And the equity market is growing tremendously as well. So I would say that it is time to relax capital control a little bit, especially given that we sort of trying to accelerate our financial market reform and open process.
So, Rebecca, if China speed up financial reform and open up its finance more, how will Americans understand this?
The U.S. has been pressing China to move toward a more market-based economy for many, many years. Certainly in the long run, this is something that is very much in line with U.S. policy. If we look at a lot of the China rhetoric that's coming out right now as focused on the election, it's almost decoupled from all of whatever coupling or decoupling we might see in the actual markets. It's very much in the Republican Party's advantage right now to talk about China as a threat, to talk about things the U.S. is doing to strengthen its position, while at the same time economically it's good for there to be more trade between the two countries. It's good for China to be invested in the U.S. The trade deal is calling for China to increase its imports of U.S. goods. On a practical level, there are a lot of reasons for business to continue and possibly strengthen.
And you just mentioned the trade, because many experts are saying that the trade pact between the two are actually to be going strong. China is buying from America. Do you think this could change because pressure has been mounting? The political atmosphere is becoming more antagonistic. Will this change?
From the data I've seen, China is still below its targets for imports under the deal, and yet is also increasing what it's buying. So there's sort of slow movement, but lagging a little bit behind some of the benchmarks that may have been set. For China, I would imagine they are playing the long game. That would be consistent with what we've seen. And in the U.S., again, there's this difference from rhetoric and from economic focus. You had Trump talking last week about how the trade deal is less of a priority for him. At the same time, many of the business interests that support him will want to see trade ties with China at least hold steady.
And Hong Hao, do you think if the U.S. side continue to tie the screw, maybe China will considering not following up on the trade deal as promised?
It's highly unlikely. Even though China is falling behind the schedule, I think China has completed about 30%, 1/3 of the purchase. But now we're already halfway into 2020. So I think we're slightly behind the schedule. And I think the reason why is because the logistic transportation because of the virus outbreak. So it makes it harder to buy U.S. goods and import it, covering great distance going from the U.S. to China. But I think going forward, it is still in China and the U.S. best interest to trade and also to complete the trade agreement. And the reason being, I think a lot of the U.S. companies operating in China, they still need to import U.S. parts to complete the products that is manufactured here for exporting and also for satisfying Chinese needs as well. And I think for China going forward, I think having a sort of a relatively healthy trade balance with the U.S. It actually helps both countries in the sense that China doesn't have to buy as much U.S. Treasury bonds as before. So I would say that it's a win-win situation, and I think it's in the best interest for both nations to continue the trade deal.
Well, that is the case. It's only both sides are still rational. But NR, we are still less than 100 days until the election. So far, all the overtures done by the U.S. has not been very friendly, actually very harmful, and it could go which direction? Do you think maybe trade war will again emerge because of the political situation in the U.S.?
Undoubtedly. I mean, Donald Trump has only one card, as we saw with the O'Donnell and Associates big book, Coronavirus Republican Strategy to re-elect the President and the Senate. It's only one issue: attack China. So he has nothing else. He can't say, I did a great job with coronavirus, although he is trying to say that. No one believes it.
But trade war will also deal a huge blow to U.S. economy, which is not something he wants to see before election.
Yeah, but I mean, right now it seems like he wants to, as he is doing domestically in the U.S., he wants to trigger some sort of confrontation so that he can say he's the law and order president in the U.S. and similarly with China, perhaps something in the South China Seas where he can then say that China is the enemy. Because he can only get elected on patriotism now because the economy is not going to be strong enough for him to stand on.
Let's talk a little bit about the long-term implications, the dollar. The dollar index against major currencies fell to a multi-year low. U.S. investment bank Goldman Sachs issued a bond warning that on Tuesday the dollar is in danger of losing its status as the world's reserve currency. So, Anna, do you think this is exaggerated? Because this is COVID. Of course, America is issuing a lot of debt, and Americans are living a very hard time. But is it a real danger for the U.S. to lose its currency status for the world?
It's a massive danger to the U.S. because the debt has been financed through these cheap money flows in. If that goes away, all of a sudden the debt payment for the U.S. will go up. Now, we've been adding debt in the U.S. at a tremendous level because of COVID-19. How is that going to be paid back? I mean, there's real questions about what the Treasury is doing, how long they can do that. Can you write an unlimited check? What happens when the time comes to pay up? So right now, it's almost an inevitability that the U.S. dollar will not be, in 5 years, the currency of record. All right, that there will be changes. There might be multiple currencies. It might be more slanted towards China. But this does not mean that China is aiming at this direction. Quite frankly, it's been forced into this because of what the U.S. has been doing with the banking system. As I said, they control it through the SWIFT system, which is part of the U.S. So I do see that there is going to be a change. There's no reason to take the additional currency risk. All right, you and I want to trade. Why would I buy dollars to give you dollars when our primary trade can be done directly in your currency and mine?
Okay, we've also collected some opinions from social media users on the possible finance and capital wars between China and the U.S. Make ballot, he said, the dollar, a cold war with China is slowly leading to loss of reserve currency, which leads to the Fed not being able to bail us out of future crises. Yes, this is probably also Ray Dalio's point. The last time that the world has seen a danger of this is probably 1930s. There was great power rivalry and also indebtedness of a major country. Rebecca, are we repeating history in terms of the indebtedness of a major economy also joining a great power rivalry?
Debt itself is not a problem. The question is sustainability. As long as interest rates are low, as long as the dollar remains the world's reserve currency, which I do expect to be the case in 5 years, the level of the debt is not so important. What is important is that the U.S. continue to issue in a responsible and transparent manner, that the dollar remain a more global and sturdy currency than some of the other major currencies. For example, the euro still is not a fully mature currency. The RMB we've already discussed. Right now, the dollar is where you need to be if you're going to be transacting a lot of these things.
Hong Hao, do you agree that the U.S. is still acting in a stable and responsible manner?
I have a less sanguine view on this topic. I would say that, in order to save the economy, they have to go all out for it. So I think as a result, the U.S. Fed's balance sheet has expanded, almost doubled in the past 3 months. And I think, the market consensus is that to plug the hole in the U.S. fiscal deficit, the U.S. Federal Reserve's balance sheet would be 20 trillion in a couple of years. So I would say that it is kind of hard to fathom, once you get to a balance sheet that size, and also you have issued so much that it does no harm to the dollar.
But we haven't seen much danger of inflation despite so much debt in the U.S. Or at least danger of inflation.
Yes, I would say, I would say that, the time is not immediate. I think, we're looking down 7 to 10 years down the road. But regardless whether the U.S. dollar is losing its reserve status, the thing is that, the dollar as a currency has its own cycle as well. And I think the dollar cycle has already peaked for this current cycle. So as a result, whether the U.S. dollar is going to lose its reserve currency status in the next 5 to 10 years, I think more likely than not, we're going to see a weakening dollar going from here.
And Ray Dalio also mentioned the cycle thing, because when you are in debt to a level, that means you're going to run into trouble. Reports show the U.S. Federal Reserve's balance sheet has increased from $4 trillion in March to $7 trillion today, and that is only 3 months as Congress passed trillions of dollars in stimulus funding. And they are still planning to fund more because you haven't reopened your economy. We don't know when that's going to wrap up. Rebecca, should we worry?
The central bank's job is to be a short-term emergency backstop for the economy, and that's what it's doing right now. If the debt continues and continues along the lines that our colleague has said, it may weaken the dollar, but that's different from changing the dollar's global role.
You don't think it will change the dollar's global role for the long term or for the short term? Rebecca?
Certainly not in the short term, and in the long term, we have to see a different currency emerging that could take over that role.
There is no
right
alternative.
Now, there is no other currency at the same level.
And Zhu Min is a former deputy managing director of IMF. He said the concern isn't whether the U.S. dollar will see an accumulated decline of 30% in the future, but whether there will be a blow-up event that causes a sudden loss of confidence in the U.S. dollar. He didn't mention when, but it seems he is expecting a historical event that will probably drag down the status of dollar.
Yeah, you could see that.
The IMF's job.
Yeah, go ahead, Rebecca.
The IMF's job is to look out for potential emergencies. That's what they're for. If the IMF had a specific thing it was worried about, it might flag that particular event as a near-term concern.
He's a former deputy managing director of IMF, by the way. NR?
Yeah, I think quite clearly there's a danger of any kind of armed conflict would trigger this, obviously. The second part is if you start having rising rates very quickly, a loss of faith in things, and
that won't happen in the short term. That's for sure.
We don't know what's going to happen in the short term. Remember, currencies are fiat. It's all about confidence. I'm not going to put my money into a currency that is slowly losing value, or my expectation is. The expectation with the dollar is that it's stable, that I can count on its value, so therefore I can transact in it. I can take my money and put it in there and then transact with somebody else.
And do you think Americans and people elsewhere still have faith in the American dollar and the American economy?
Well, less and less. It's at a 22-month low, against the basket of currencies. You're seeing a lot of weakness. We've already talked about the issues with the amount of debt. Now, Rebecca can say that, traditionally this has been work, but I don't think traditional tools work anymore.
All right. Thank you very much, NR. Thank you, Rebecca and Hong Hao. You've been watching Dialogue here on CGTN. I'm Zhu in Beijing. Thank you so much for watching. Goodbye.